microphone should be switched to silent. So if I can begin with introductions, I'm Deputy Helen Miles, Chair of the Corporate Services Scrutiny Panel.
I'm Deputy Lucy Stevenson, Vice Chair of the panel.
Deputy Jonathan Renniff, Member of the panel.
Constable David Johnson, Member of the panel.
Elaine Miller, Minister for Treasury and Resources.
Ian Gorst, Assistant Minister.
Richard Bell, Treasurer. Richard Summerskill, Comptroller of Revenue.
Phil Ashley, Interim Group Director of Finance Business Partnering Analytics.
Jonathan Russell, Deputy Director of International Revenue Jersey.
Okay, thank you very much. And I think we've got 2 hours scheduled for this hearing today. As usual, we've got probably more questions than we'll have time to answer, so we'll try to be concise. But it is just to mention that a large portion of the hearing today is going to be about the proposition and report around the Jersey Capital Investment Fund, which gives us an opportunity to inform comments at a later date. So I'm going to kick off just with some questions around the fund structure. So, Minister, can you briefly explain the structural changes being proposed by the draft regulations for replacing the consolidated fund with the Jersey Capital Investment Fund and General Revenue Fund, and how this new arrangement will strengthen the financial position?
Well, I think it is largely as you've just described, largely as it says in the tin. We will take what is currently the consolidated, these regulations are setting out the kind of skeleton for the new capital framework going forward, and there'll be obviously revenue implications of that. So this is simply the changes to the public finance law to create the fund. What it will do is split what is currently known as the consolidated fund into two funds, which will be the Jersey Capital Investment Fund, which will hold funds and through which funds will flow for capital and asset related spend, and then the General Revenue Fund, which will deal with our general day-to-day spending on services. So the General Revenue Fund, much as it does at the moment, will receive all our general revenue income, so tax income, other departmental charges will go into that fund, which will then pay the relevant amount into the Jersey Capital Investment Fund. That will also receive things like rental income from where there are rental charges on estates, properties that have been let to third parties, for example, and any proceeds from asset sales. So any sort of property capital related income will go into that fund, and that will be used. It will really be ring fenced for capital spend. So that will include things like general day-to-day facilities maintenance, I think. No, maybe not that. So general maintenance of keeping properties in a good state of repair and fit for the purpose that they're being used for, to make sure that we have got the assets, that what we already have is maintained properly and in a timely way, so that we hopefully don't end up in another 10 years with a building needs a new roof, and because we haven't done anything with it for 10 years. So that will be supported by the long-term capital plan, which the team have been working on for some time. Anyway, that kind of is the foundation for some of this work, which was subsequently swept into the Capital Invest in Jersey programme. So that is something we've worked on for quite some time, to identify what assets we have, what maintenance needs there are, what the depreciation requirements are. We're proposing to structure it in such a way that monies will go into the Jersey Capital Investment Fund. So I'll keep looking at the little diagram. And if there was an underspend, so for example, if there was a project, the underspend would be retained within that fund. We don't have a mechanism. We're proposing that monies cannot come out of that fund for revenue spend. You know, if there were underspends in the revenue fund, those underspends could go into the capital investment fund, but not the other way around. So it's really about trying to preserve capital budgets for capital projects.
I understand that, and you've explained how the new structure is going to strengthen the financial position for the investment so that money can't be taken out. But that is going to reduce the flexibility that you have at the moment to move money around. So, for example, money has come out of the capital budget in order to fund overspends in health, for example. So what else are you going to have to put in place to make sure that you've got that flexibility? Where else will the money come from if you can't take it from the capital?
Well, we would have to fund that through general revenues, or I think that feeds into the sort of underlying ethos that we have been trying to work towards in the last couple of years, is really trying to rein in revenue spend. We are arguably spending more than we should be given the state of our income. So there will be, we do just need to look, it will require more discipline around revenue spending and everybody remaining within budgets. If there were growth, if we did need more money, then we would be looking to fund that from revenue income or other charging or other sources of income.
Okay, would that include the central reserve?
There will be a central reserve. We'll continue to have a central reserve as we do at the moment, and that will hold, the central reserve holds things like, general funds for contingency. For example, if we budget on the basis of inflation being a certain amount, if inflation was a higher amount than we'd anticipated, the central reserve would fund that. It funds pay rises, things like that.
Because at the moment the central reserve is quite low level. There's only 5 million in the central reserve. So at the moment, if you were going to fund anything else, you would be looking at the capital investment fund. So how are you going to better manage the central reserve to make sure you've got that kind of...
I think it's all looking forward. I mean, the capital investment fund, it will. We do need to. One of the things that the future Assembly needs to think about is how we fund that fund. So we're looking at existing capital budgets. So the money that we already spend will go in there. Capital receipts will go in there. We may need to look at reprioritisation of spending and efficiency savings, or we may put those in, or we may have to keep them to build the central reserve if we thought that was necessary. So there will be a bit of getting to grips with all of those things.
Okay, so but is the plan to fund the central reserve before you top up the capital investment fund?
So we need to do a piece of work. Firstly, I'll just put this down this marker. We need to do a piece of work in terms of how big the reserve should be for a medium-term plan. So if we were doing as we intend to bring forward the regulations to the next government, should they decide to back it, to have a 3-year plan after the first initial year of a government, that will require us to hold a larger reserve to span the 3 years. It will be possible, subject to what we do there, to take into account if income were to go up during the period, and we'll need to think about how the mechanics work in terms of the stabilisation fund in the event that future income drops off. In answer to your question, we do hold a position as officers the reserve needs to be higher. That number is roughly the same provision that we've had since I can remember. And it's fair to say that it needs to increase. But what we also need to do is therefore make sure that those funds are therefore used for urgent and unforeseen in accordance with the policy. So greater financial discipline around the use of the funds would
Result in,
give you greater flexibility should you need it further down the line for urgent and unforeseen matters.
Okay, thank you. Can you explain the rationale for the change of the calculation for the operating balance of the General Revenue Fund and the implications of doing that?
The change in calculation.
We played rock, paper, scissors and Phil was going to
Yeah, so I mean, I think from my perspective, this effectively introduces a bit of a triple lock to properly describing what our surplus position should be. So as you'll know, in any given period, if economic times are good, we would recommend that the Assembly approve a budget that is in surplus. That means that we are spending less than we bring in from an income perspective. We should also make sure that that surplus is sufficient to cover depreciation. That's the accounting treatment of how we measure the use of assets over time. But this adds in that we should also reflect on the base transfer, we've called it, to the capital investment fund. And that's linked to what the long-term capital plan describes as our minimum spending needed to sustain our existing asset base, to provide for the maintenance of that asset base on an as-is service basis. So there'll be two dimensions to that long-term capital plan. One will be more change and improvement focused. But on that, the whole intent of this is to try to ensure that we are adequately maintaining our existing assets. And by providing for that base transfer as a minimum, then we've got a much clearer picture of what actual sustainability looks like.
Okay.
And so it complements our existing measures.
In respect of the net revenue expenditure, page 8 of the report on the proposition, there's a couple of lines there. It's presumed that all staff will be paid through the GRF, and where staff work to deliver capital projects or maintain assets, the appropriate costs will be recharged to the JCIF. Can you just clarify exactly what's meant by that statement and the rationale behind it?
Do you have that?
Yeah, so I think that, the intent here is that alongside the capital spending needed to for major refurbishment or extension perhaps to buildings that we operate, that we'd also be protecting funds that are for the day-to-day maintenance, and they're revenue in nature. Typically they would feature in a departmental budget today, but they have been targets during times of efficiency cuts, soft targets for departments, and so we want to make sure that spending is maintained and protected. It gets a little complicated when you reflect on the fact that staff are involved in maintaining buildings. So whilst you would protect the budgets associated with them, you don't want to start necessarily moving staff to be paid for by by a capital investment fund. So we would allow for the recharging. That would be codified in the public finances manual or potentially through a ministerial policy. I think really important that we've got robust governance that defines what is legitimate in terms of transfers, so that it isn't an outlet for spending from the fund.
Exactly, and I think that's sort of where the panel were thinking, because arguably the entire Department for Infrastructure has staff who work to deliver capital projects or maintain assets. So I think the question we were thinking is, what is to stop the General Revenue Fund cross-charging for the entirety of the staff budget from the Capital Investment Fund?
It's already the case that many staff are recharged to capital. So those staff that are recharged to capital in an existing approach, we would mirror that. Most of the employment cost in infrastructure is actually about running services. So they are running the energy from waste plant, for example, as opposed to solely maintaining it. We wouldn't necessarily charge those costs to it. We're working with the Department for Infrastructure now to codify exactly how we would assign staff costs, but we do so in a transparent way, published through the Public Finances Manual.
So nothing would happen until that had been codified and it actually appears in the Public Finance Manual. So it can't be an ad hoc, we're running a massive overspend, let's just recharge it to the capital plan. Okay.
Yeah, recharges have to stack up.
Yes.
So we have this ourselves in Treasury, or staff that we recharge and other costs that we recharge to different funds. They have to stack up and would be subject to internal audit as well.
Okay.
And I think, for example, I think in Social Security, there's a staff recharge. There's, in terms of the staff who run elements of the Social Security Fund, there is a recharge for that support, which is within the law.
Carries it forward.
Yes,
nothing.
but you wouldn't use it to.
Okay. No mischief possible in that line.
There's already a requirement for an evidential basis to be in place to justify existing recharges. So a lot of this we have established practice around.
Okay.
There is a minor risk here that we need to address, but we're very conscious of that. I think the intent here is to ensure there is no potential outlet in that respect.
Thank you. Can you just provide us an example of how the new structure will actually work in practice? You've got a scenario.
Such as?
I don't know, if you want to develop a new energy from waste plant, for example.
I don't think that will change dramatically the process for if someone said we need a new energy for waste plant. The whole process of approving that, bringing it to the Assembly isn't being cut out of any decision making here. You know, this the same project management rules still apply in terms of a significant project, so that project will have to go through the normal approval project management processes. It's just that the funding will be structured through the capital investment fund.
So will there be any change at all? Will these regulations bring any change at all to the powers of the State's Assembly?
I don't think
No.
so. No.
And will they bring any change at all to the powers that you have as Minister for Treasury and
I
Resources?
think this on its
Well, it
own
restricts the
changes.
minister in the way that you talked about earlier, not being able to transfer money out of the capital investment
Okay.
fund out of capital programme to cover revenue budgets.
I mean, you would argue that it strengthens the Assembly because the money that the Assembly votes for capital projects will go into the capital fund,
Yeah.
and therefore the Minister or the Council of Ministers can't do other things with it.
Okay, thank you.
Can I just pursue one line with that, which is clearly the aim here is to introduce a structural rigidity that doesn't exist at the moment. But there must come a point at which that could have unintended consequences. For example, if there is a considerable underspend, you're going to hold it in the capital investment fund on the basis that that project will go ahead at some point. But if it rolls on with another underspend in another project, you could get to a point where you're holding quite a lot of money in the capital investment fund with a inefficiency, if you like, in terms of how that's being used. Is there a sort of thought about that and what the pain threshold would be in terms of that kind of thing? Or are you simply prepared to let the capital investment fund build up the money regardless?
Well, not regardless. I suppose I qualify this to say I would hope that some capital programmes would underspend. What I would suggest that more likely to happen is that projects will delay spending.
Yes, that's what I meant.
And that
So for
therefore-
a school, for example,
Yeah, so
a gas place has
at
been
that
pending
point,
for a while.
Yeah. At that point, you'll do an appraisal to figure out whether it's still possible within the capacity of the organisation and the capacity of the island to be spending the money. There may therefore be, through Assembly decisions, changes to how much gets transferred, but there'll be Assembly decisions. So I think the law does provide that the Assembly can change any amount that was envisaged to be transferred, but that would be at the Assembly level law.
So it would be an Assembly decision if that situation were to develop. Okay, thank you.
Yeah, I don't see the fund as being generating a huge surplus of cash, that because once you've got surplus, there'll be people saying, oh, I'll have that for this, that and the other thing. So it will still be about managing the money we need rather than creating a huge pot of available funds for pet projects on capital. But projects do get delayed all the time, and there will have to be
That's
that.
my point. That
It's similar as
a
the
rolling series of delays could lead to quite a large accumulation of capital within that fund that may be hard to spend at this, to draw down in the way that you want. It could just build up year on year.
So I think in response to that, there are two. Firstly, I think set the scene. It's always been the opposite problem. For a long time, we've under-provided for capital overall. So we've got a large backlog of things that we need to address. We know that. We need to make sure that future budgets are providing to resource all of that. What this fundamentally does, alongside ring fencing, protecting money, is encourages a much more long-term planning horizon. So whilst there will be inevitably some plans that don't go to plan, aren't delivered to plan, they're over-optimistic, we need to be ensuring that we've got plan B, plan C ready so that other projects can be accelerated, that we're getting to a level of maturity where when we set budgets in a long-term capital plan, they are robust in the first instance and likely to go ahead as planned, but where they don't, that we've got the opportunity to bring other projects forward to maximise impact for the funds that we have available to us. Of course, through the annual budget process, you'll also reflect on whether, if there is a degree of spare funding in the system, whether you would want to use the budget process to reassign cash to support revenue investment. More than likely, there'll be plenty for us to do in the next 10 years at least to accelerate other projects and ensure that we're rebuilding the island and renewing it.
The other tendency, though, is to over-commission capital projects, £120 million worth of bids and so on, which presumably, as you say, the aim will be to discipline that process.
We've shown a degree of that in recent years. The end year position, we've had a lot less underspend on capital than we have in previous years. So we're starting to encourage meta discipline in that respect.
But it is where the 3-year budgeting plan
Yes.
really fits together with this, because then it addresses both not having enough, and if you've got money sitting there, you can make a political decision in the Assembly to, you might actually want to reprioritise capital at that point. We might do something else.
Okay. In terms of the regulations themselves, can you clarify what is being brought forward now as opposed to what is going to be needed in the future to make this, to bring this to fruition? So, the budget in 27, the next budget will presumably include some elements of this, enacting this, and there may be future regulation changes which aren't in this batch that are coming through. So can you just sort of outline how far we get with these regulations and how far, there's still work to do beyond them?
So there's, in terms of the regulations as they are
Proposed.
in respect of capital investment fund, then the regulations will be turned on in 2 tranches. I'll have to come back to you to tell you exactly which ones are turned on, but they're turned on, or should be turned on by the minister or the new minister, depending upon when those orders are put in front of the minister. That turns on the ability to budget in 2027, i.e. to present to the Assembly a budget that has the capital investment fund in it and the general revenue fund. At the point that's agreed at the start, also that it's effective from the start of January 2027, we'll then enact the regulations that basically turn the consolidated fund off and see the capital investment fund and the general revenue fund, in accordance with the decisions made in the Assembly, turned on, in my sort of language.
Yeah.
In terms of the future, this set of regulations doesn't introduce medium-term financial planning. That will come as a second order. So what we're envisaging is where we perennially ran up against an issue in the previous legislation that had a 4-year medium-term financial plan, was that that first year you always had to make 1 year because you did not have the time to work with that government to do so. In actual fact, the way it worked was the last year became the last 18 months of that plan became the first 18 months of the next government. It didn't work very well. What I'm suggesting here is the first budget a government puts in place would be a 1-year budget. That government would then agree a 3-year budget. That's not in these regulations. That's something that comes later. But as 2027 will be a 1-year budget, then we can agree that either in budget 2027 or shortly after, in order to do that for a 3-year budget from 2028.
And that's it then. Basically, then it's just about how you fund it.
Yeah.
It's just about where the money's going to come from to go into it, put extra resources as well. Okay, in terms of
Just that, yes.
Yeah, just that. Yeah. The public finances manual will need to change, I think, to reflect these changes. So, what's the process for that? And will Scrutiny, the Assembly and so on be involved in that, or is that a technical exercise that's going on in government that will simply produce a lovely, nice, shiny public finances manual?
That will largely be a technical exercise that splits out the existing powers, responsibilities and rule that sit for a capital project in the consolidated fund, just splits that out into 2 funds. Yeah. Our process for doing so is we internally we'll work through how that should work. We'll do it at the same time, check off to see if there's any improvements we might make to those general controls. We will consult with the CNAG when we put that together. And then when the Minister makes the decision, they go copied in full to every change in the Public Finances Manual goes copied to the Public Accounts Committee.
Yeah, and I think that is something we do every year. We do. There does seem to be a round of changes to the Public Finance Manual every year to pick up, whether it's CNAG recommendations or just other best practice things that have developed in the accounting world, I think. And I go through all those, the team put them together, I go through them, and then PAC can look at them.
So the timeline for
But they are
that,
technical.
the timeline for the changes to the Public Finances Manual, do they have to be in place before the budget comes in, for example, the next
There
budget?
might be bits that do, but we will want it in place before the budget, because the budget, the financial year comes very shortly after the budget. So you do need it in place in advance so that any changes, which aren't that considerable given that we're splitting responsibilities that AERs and other named people have for one fund into two funds. Head of expenditure responsibilities will still be the same. We will have to issue AER responsibility letters that split out between the two different funds, etc. But the aim will to have it done well in advance of the budget.
In terms of governance arrangements, are there any significant changes in governance arrangements through this proposition?
No, I'm not thinking there are quite as much. They might want to change some of the definitions and terms of reference as they apply to there's an officer capital group that feeds into the regeneration steering group, for example.
So the Public Finances Manual has quite a lot of
Well, we'll deal
governance
with it.
in this.
Yeah.
So those things will just continue.
Yeah.
Yeah. Okay. The report to the proposition notes that full implementation of the Capital Investment Fund will be brought forward as part of the budget. Full implementation, what does we mean by that? What is the thing that happens in the budget process that won't have happened up until that point? What do you mean by that?
Well, firstly, the law will be approved, but it won't be enacted until that time. We will have to set out the transitions in terms of transfers of, at the moment, assets are held in the consolidated fund. So when I'm talking about property, plant, equipment and such like, they will transfer into the capital investment fund, or the Jersey Capital Investment Fund. So there's that, for example. So we've got all that to do in the background, largely just technical, and then the budgets will be set in the budget as they are to be set out for each of those two funds. So broadly the level of that we have to bring into force.
So by implementation, you mean the actual allocation of funds and what they're going to be spent
Actually
on. and
creating
those
the
sorts of
two
things.
pots.
That's what full implementation refers to. I think we've done question 13. So
Yeah, continuing with questions on the JCIF. Article 34B outlines what must be paid into the fund. Briefly, proceeds from the disposal of assets, income derived from rental, income derived from investment, and other income specified in the appropriate budget. So how is it determined at the outset what assets will be held in the fund?
So we will, I do think we set out in the report what they would be.
Is an established list already there?
Yeah.
Well, we've
There's
got
not
existing.
a list asset by asset, but we will run through the asset inventory on the general ledger and transfer the funds that qualify as assets in the sense of property, plant and equipment into the fund.
I just
The according
question how
liability-
close they will be defined, really.
broadly in line with accounting standards in terms of how you would describe whether something's an asset.
It's that narrow. Eh?
That amount of latitude. No. So broadly in line with the definitions of what you'd expect if you were to see them on the balance sheet of the States of Jersey.
So there is an illustration on in part 6 on page 20 of the report, I think, which tries to show elements that would remain within the general revenue fund. So assets under 1 year, for example, but fixed and intangible assets would all be transferred.
Okay, thanks for that. Thank you. And when and how can changes be made to the assets once held in the fund? What's the procedure for changing assets?
Do you
Well,
mean changing definitions? Or no?
What do you mean an actual asset? Well, I'd imagine that once an asset, if it's a real property, once that is held within the fund, if it was going to be disposed of, it would be disposed of pretty much in the same way as happens at the moment with the receipt going into the fund.
Okay.
That's what you.
Right, and going on to the an ongoing matter of the rental or leasing of assets. Can you clarify what that means?
I think where we have
What
properties,
covers or doesn't
where
cover?
there are property, well, it will come to it, is there a real asset which sits within that, a capital asset within the fund, which generates some kind of rental or lease income? That income will go within that income will go into the capital investment fund. And it will then be used for things like the ongoing maintenance of that building or other costs relating to that asset or other assets, rather than going into the revenue fund and being used for something else altogether.
Okay,
Right, isn't it?
moving on to the what's termed softer maintenance, like costs of running services associated with the assets held in the fund. Matters like cleaning will not be managed by the JCIF. Can you explain the rationale for transferring that obligation elsewhere rather than within the fund?
I think the theory, the thinking there is that, you know, if you had to re-roof a building, that is clearly capital maintenance. I think we've got the term hard maintenance somewhere. So if you were re-roofing or putting new windows in, that is maintenance and depreciation, whereas someone coming in and cleaning is more like a revenue spend, keeping the building clean. And the windows washed once they're there is more in the nature of revenue spend than capital spend. So those would continue to be funded from the revenue fund.
I mean, there's clearly grey areas, aren't there? If their central heating system breaks, is that a capital spend or is that a revenue spend?
I mean, yeah, to be clear, they're revenue, but they are
Capitalised.
yeah. Obviously, there is a balance you have to strike here. We don't want the scenario we talked about earlier, where a whole department gets recharged to this fund. We're trying to understand what are the just operating expenses of the building, what are the things that are about sustaining its fabric, replacing equipment within it. And those things are what we want to categorise within the protect rather in the capital investment fund. So, yeah, the new radiator and the costs thereof, yes. The cleaning, no.
So it's quite a grey area then. I'm trying to sort of.
I mean, there are established definitions within the sort of property management sphere. So soft FM, hard FM does mean something to people who work in that space. They're not just terms that we've come up with. So that's how we're trying to split it. And then there are more detailed definitions, you know, that follow within them.
Okay.
So it's not all a grey area. There are things that are very much dry maintenance, and there are things that are very much soft maintenance, and there are often a minority of cases in the middle. But as Phil says, they're generally quite recognised as to which side of the line they fit.
Okay, I'll leave it to that, Chair.
Thank you. Could you clarify how the fund could invest to derive income, please?
Could invest to derive income.
So all funds have an investment strategy that will sit alongside them. Those investment strategies sit alongside the purpose of the funds and what the funds are generally used for, but they also take into account back to your question earlier, the amount of investable cash, for want of a better phrase, or funds that are sitting in unused. The investment strategy for this fund, subject to us being proven wrong in the future about how much balance is sitting there, I don't expect to be anything other than short-term investments rather than investments held for the long term. So I wouldn't expect the same sort of strategy as you have with the strategic reserve, for example. But there is a requirement upon us to have an investment strategy in place, which will largely talk about highly liquid assets that are not volatile in their value.
Okay. And so the Social Security Reserve Fund obviously was used to invest in government assets to acquire the new government headquarters. Is that kind of investment anything that might be on the table for this investment fund?
I would have thought.
In one sense, that's exactly what it does, because it invests in schools, it invests in drains, it invests in those physical assets, but not in the sense of an investment asset. It's not out with the possibility, should the Assembly choose to do so in the future, to use the fund in that sort of basis to create an investable assets. But we see the fund as having that main purpose in the way that we've invested in the office building as part of an investment portfolio. This is more about the state's actual assets as opposed to the ownership and the return that's been earned on that. But it's not outweighed. Then if you think about some of those assets currently largely internally, I can't think of an exception at this point, but there are one or two buildings, and maybe one of those would be Maritime House, where we rent out Maritime House to ports, for example, so it creates a return, but it's still not in that sense of held as an investment, it's held as an asset that we rent out.
But under, I think as we just explained before, rental would come back into this fund and would stay in this fund. So that might be some of the money that's potentially building up, or not.
I'm not sure there'll be a lot of money building up.
Okay.
Because I think the money that comes in will broadly be used to fund maintenance and replacement of assets.
Yeah.
Rather than
But
creating
it's not being ring
continuous
fenced for that
surpluses.
building specifically. It's being ring fenced for capital generally.
I mean, all money is fungible, so you can move it around and decide which bit funds which. But in the first instance, our existing corporate landlord model is established to try to set rents at a level that allow for the maintenance of that asset. So in many cases, it will be that we are renting a building externally. That income coming into the state will therefore allow us to continue to maintain that building. It could be that we are in a position in the future where we're generating surpluses through that rental, in which case it could reinvest in the wider public sector estate. But it's just trying to get a more, or give life to what is our existing corporate landlord model, where income generated by assets is used to reinvest and sustain those assets.
Okay, thank you. And from investing to borrowing, can you explain the process by which the Jersey Capital Investment Fund can borrow to fund capital, and how will that be managed?
So, first and foremost, only in accordance with decisions made by the Assembly. So none of that changes, proposals to increase borrowing limits or to borrow for specific projects will still all come forward in the annual budget or the 3-year budget, as we hopefully get to one day. So none of that changes, and the way we would therefore manage it is that it's in a different fund as opposed to being a consolidated fund. So it's as it is now.
Okay. So nothing will change as such. It is going to change. Of course it's going to change, but
I think in
the
terms of borrowing,
process doesn't change. I think the process will still be, this isn't about opening up a whole new stream of borrowing. There will always be cases where borrowing is necessary and approved by the Assembly, and the borrowing will be done through Treasury in the same way as it would be done at the moment, with appropriate debt and legal and accounting advice, and with a repayment plan.
It will have greater visibility, I guess. That's the one change. You will see the borrowing, it will be in that fund, and it will be separate from borrowing that's being done elsewhere in government for other purposes.
So borrowing
Although I think
for
all our
purposes-
borrowing is visible at the moment. It's
Visible
not
in the sense
concealed
that
anywhere.
of clarity around purpose.
the linkage exactly to what that borrowing is for.
Yeah.
how will capital investment needs be assessed, and who's going to make those decisions around what will be funded and when? How will they be prioritised and through what criteria?
Does that come into your long-term
Yeah,
capital plan?
Exactly right. So the long-term capital plan is a vehicle, as the report sets out. There's two components to that. As I mentioned earlier, there's an essentials component. In terms of then how we prioritise that work, it's the established process we already have to set capital budgets, look at the needs, understand which of the strategic needs are highest, and prioritise investment in those assets, reflect on the extent to which and the pace at which we can deliver. So there might be a burning need, but it takes us, as we have discussed today, a lot of time to build a school, and so we need to obviously make sure that our plans are deliverable. But this isn't necessarily a vehicle for changing our prioritisation criteria. What it really does is get us planning on a longer term basis, making sure we're thorough in that planning, and that there's a transparency across the Assembly that if we were to change things around, it's very visible. That if we were to not provide for the funding that is needed, it's not possible if it's the essential component of it, or there's displacement because you've changed your plan and it's now very visible that something has been removed, and there'd be a need to justify that to the Assembly.
And just for those and members of the public who perhaps don't know how things currently work, how are those decisions made? How will they be made going forward? Who that's a question for.
I mean, ultimately, they are made by the Council of Ministers. Departments put together business cases to explain what funding they need and for what purpose. They're reviewed by the Treasury. We reach a recommendation, and that is then put forward to the Council of Ministers, who take a decision whether to invest in something or not.
So that will remain the same. So the long-term capital plan is still the Council of Ministers.
Well, it then goes to the
It goes to the Assembly,
budget.
therefore,
So
in the
again,
budget.
the
That's
Assembly
right.
ultimately says yes or no. It can amend it, can't it? It can say, no, we don't want that. We think you should be doing this.
Yeah. So that all stays the same. Yeah. Okay.
I think the big change is the long-term capital plan providing a greater evidential basis for what projects should be prioritised.
Okay. Thank you. And then the proposals for what's going to be transferred into the New Jersey Capital Investment Fund, are they going to come forward with the budget for 2027 as what's going to, for approval? So the State Assembly get approval over that. And is that going to be, are they amendable, first of all, those State members? People are nodding. Could somebody
They are.
confirm it? Thank you. I think just for the record, we probably need people to say it out loud, don't we, rather than just everybody nod. Thank you.
Although it's always, I'm sure it's very frustrating for the team when they spend a huge amount of time and effort coming up with a plan, and somebody then tries to put a shovel through it, effectively. So I think there is, I think maybe we do need more discipline all round to make sure that when we have a plan that works, that plan is allowed then to operate.
I think in terms of the assets, I would think that's more of a definition matter, back to accounting standards, how they're disclosed on our balance sheet. For example, we'll define the assets. It would be a very, very extremely long list of all those assets that would be transferred from the consolidated. And remember, we're not transferring it from a general revenue fund. They exist in the consolidated fund and they go across. And so from the assets and liability basis, see very much as a definition, you will have a number that relates to each asset class, but you won't have a list of all the...
I think what Deputy Stevenson is talking about, though, is what new sources of funding might come forward.
Oh, well, that's a different question.
In terms of,
so that's another...
in terms of, if there's going to be a I don't know, tax on the uplift of land values when it's rezoned, for example, that would be a classic thing which, were it to come into place, you might think would go in here. Those decisions...
Sorry, I thought what Deputy Stevenson meant was we
Deputy
produce a
Stevenson.
capital plan and people
I'm
say, no, we
interested
don't
actually
want
now
it to
in both
re-refill
of it.
perhaps.
Actually, now you've both started the conversation, because I can see that actually some people may have a view on, even if you wouldn't like them to have a view on your list, some people may have a view on that list. And I'd first like to ask if States members are going to be asked to approve that list, or is that an internal matter?
I've seen very much. In my head, I'd seen this as a straightforward definition of assets being transferred, rather than... I can't find much in the way of consequence as to whether an asset that's in a grey area might be, well, it's an asset.
But if a States member wanted to, they would be able to bring a proposition to say,
they could name a
I
particular
don't want
asset.
Montague included in this, for example.
Let's not maintain the Kennebury School.
Yeah.
But today that would be
That's what I'm saying,
visible.
it'd be really-
So, sorry, Miss.
I'm going to say if we have a capital plan that's worked out with, so my vision of the capital plan is, it says these are the assets we have. This is the amount of money we have to spend maintaining these assets, and when everybody's done that carefully in a concise way, what I thought you meaning was exactly that. Let's not spend money maintaining the Kennedy School. Let's spend it on something in, let's spend on Monterey, you know, that would be kind of, those would be kind of difficult decisions. But I think I think we're now confusing various things.
Yeah.
Capital management plan for me is how we maintain it and look after it once it's in there. What we get in there is what are the first thing that will transfer is the capital assets. It's almost a matter of fact
listed.
what the capital assets are. They
As
are
currently
the
listed,
capital asset,
yeah.
they're not. I don't think there's very many grey areas.
Yeah.
They move in, and then the third element is where does further funding come from? And if that was creating new charges or creating tax, hypothecating taxes, that would all have to come to the Assembly. And we've sort of had a list in previous briefings of what, you know, could be open to the Assembly, but that's kind of future funding. So I've kind of compartmentalised into kind of three different things,
Yeah. Okay.
which is
But it is clear that your example, Jonathan, that's a decision for the states.
yes.
The first question that Deputy Stevens asked is really how you describe what is the description of the assets that you want in.
Okay.
It's not really going down a long list of all these assets and say, we'll put that one in, we won't put that one in. It's, are you putting these assets across?
Okay, thank you. And just lastly from me for now, there are a number of references in the proposition that talk about how this will improve transparency. I wonder if you could just briefly explain how the structure of the new fund does improve transparency. And in asking that, I don't just mean for states members, but for the public as well.
Yeah, so I mean, from my perspective, where I was going with, I went to Lincoln Abbey School and I want it maintained for the record, please. So where I was going with that is as things stand today, that decisions are implicitly taken to not be able to do all of that maintenance that we need. What this will provide is a long-term, detailed list of all of the works that have to happen. In order to sustain the island's asset base, make sure the public buildings are fit for purpose, make sure our infrastructure lives up to Ireland's expectations. That at the moment is not visible. All you get is a 4-year snapshot of of those things that have been funded. You'll now get an objective view, as far as one can have an objective view of anything, that has been approved by officials and has been approved by the Council of Ministers. There'll be business cases underpinning all of that to evidence the need. So if in your earlier question there was any fear that you'd be sort of tied to committing to certain levels of spending on things deemed essential, there'll be the evidential basis that you can hold departments to account over and delivery thereof. And that I think is a big game changer. And alongside this fund, the funding that has been provided to sustain that plan and deliver that plan will be protected and can't be subject to short-termism. So for me, that I think will be quite meaningful for Ireland, as it will show the construction industry and Irelanders generally that we've got long-term plans to keep the island in the right condition, help us build a pipeline so that suppliers can gear up their resources to deliver if a programme builds over time. And all of that's novel and new.
Thank you.
Thank you. I just got some questions. I think we might have answered some of these already around multi-year budgeting, longer-term financial planning and the longer-term capital plan. So I think we've kind of zigzagged over some of these, but I will ask them regardless. How does the move to multi-year budgeting align with the adoption of the draft regulation? And can you tell us what the advantages and the disadvantages are of moving to a multi-year budgeting process?
Okay. Well, they are separable in that the move to the capital investment fund stands on its own. It doesn't necessitate the move to multi-year budgeting. The move to multi-year budgeting, however, will provide, or return to multi-year budgeting, will provide some of the certainty that departments look for, some of the certainty that charities look for who receive funding, for example. It will allow us to, within reason, of course. I'm not going to say to departments you can spend all of your budget in year one of a 3 year, but it will enable us to start talking about carry forwards, should there be carry forwards from underspends, for example. And some of the challenges have often been around the difference between it still exists to a degree, the difference between the school year and the financial year. It will also improve long-term planning in that you won't go from year to year with fresh initiatives. You'll be able to put all the initiatives, plan properly at the start of that 3 year period. So start as soon as we've got the first year budget put to bed for to have greater certainty about what we need to fund for those 3 years, rather than as we are at the moment. It would have to be said that the current framework is supposed to be a 4 year period, but that's not the way the legislation works. It would be voluntary of any council, ministers and assembly to limit itself to minor changes in any 1 year. This will allow all of that work to be done up front. It will allow, therefore, departments to get on with delivery rather than what feels like building a well-known Scottish bridge every year, where you start a process again of looking for more funding. So this gives greater certainty, it will allow for greater stability in the finances over a period of time. It will also come with challenges that we learn of when we first did this, around when income will change and such like. It's all for another day, but that might change purposes for stabilisation funds. As we talked earlier, it may need to hold bigger contingency reserves to cover off against any of those income changes.
Is there going to have to be changes to the public finances law then to make that happen?
Yes.
So what's the likely process and timeline for that?
So we'll have to see how much work over the summer. So we're progressing with that in any case. What that looks like, that will be a matter for the new ministers, and where that will fit in their priorities immediately after election. I suggest a lot of that work will be for new council ministers. It is in that first year. There's not a lot of time to put that first budget in place. That will be priority number one, and we'll look to see whether we can build the medium-term financial plan changes into that budget, or whether it'll come shortly after in preparation for the subsequent budget.
So that's going to be very tight, isn't it?
So you have a degree of flexibility as to how you do that. So it would, at very latest, I would suggest need to be done by the first quarter of 27.
Yeah. Okay. Thank you.
But we have been there before.
Okay. I think you've already highlighted how the funding is going to align with the long-term investment plan. That's been helpful. Thank you. Can you just identify any risks or challenges that could occur with aligning the longer-term plan to the JCIF?
Any challenges in respect of the
Transparency or any challenges expect?
Long-term capital plan.
Yeah.
Well, they should kind of operate quite comfortably together, you would think, because the capital plan kind of underpins that will help drive a clear understanding of what the spend requirement is for things like maintenance and depreciation.
Okay.
And that will then feed into what the fund needs to be able to provide those.
Okay.
The
So in terms of the long-term investment plan, which kind of goes beyond the budget cycles, how will ministers be held to account for those investment decisions?
We've got a long-term investment.
So that's in terms of the
Capital.
long-term capital plan beyond that first 4 years, which is approved in a budget. Yeah, I mean, I think a big part of what we're trying to encourage here is obviously visibility, as we've talked about. What we also want is a culture of proper long-term planning. So there shouldn't be radical change. So what we've seen in the past, and it's one of the key reasons actually that this is needed, we've seen lots of chopping and changing in capital programmes. If you look at the past 5 years, you know, how different those capital programmes look. We shouldn't see that in the essential spending component of this of the first 10 years, arguably, in this plan. Obviously, there's a degree of maturing processes in order to live that, and it might be a few years before we get to that standard. But I think it's really important that ministers are held to account for putting robust plans out into the public domain that islanders can have confidence in, and then for delivering against them. So that's one of the, I think, key benefits that will flow from this is that departments are having to plan rigorously, and that their ministers are going to want that because they'll ultimately be held to account for that in the Assembly. And again, not something we've had before because you only had a limited 4-year view.
Which brings me very nicely on to my next question, which is how or who determines what is essential capital spending, and I think the other one is change and improvement spending as it's set out. Who decides the criteria and measurements for those, and also is that something that is changeable by government, or is it something that's set out in like the public finances manual that's accepted and worked towards each time?
Yes, we tried to be pretty robust in defining essential. So it's about existing assets, quite objective. They exist or they don't. It's about maintaining current service standards. It's not necessarily about providing an extra quality service or an improved quality service to islanders. So that will require some change to existing assets potentially. If you've got a school that needs to expand, then you might extend that school. But it's all framed around providing for a base service, which is we educate children, in an existing facility, and then the maintenance of those assets. So,
and the word current to when the fund is created, or is that a movable
well, it
thing?
will always move, won't it? Yeah, because if we are, if there, so we must also, the key component I missed there was responding to key macro trends. So climate change is going to have implications for our shoreline defences. Those defences will have to be expanded to meet the pressures of rising sea levels. Sustaining them in the future will therefore be more expensive, and there'll be more potentially to our coastline defences. And so they would become the as-is assets of the future. If we expand a school, it's the expanded part as well as the original part, but it's still that same building.
Yeah. But equally, there could always be a time where we think that a particular asset is no longer needed. It's surplus requirements. We may decide, you could decide that if you build Gas Place, there will be other schools that you just don't need, and you would do something to sell them for or use them for another purpose. So there is always scope for that overall, what is in the capital plan to change as properties just are no longer required or no longer fit for the purpose we want them for.
Yeah. So
Which is the right thing to do. We should be disposing of assets we don't need.
Sorry, go on.
I was just going to say, in terms of who decides that, and so when it comes to accountability, is it ministers, is it officers, is it the Treasury, is it individual ministers? Where does that accountability lie?
So we were talking about risk earlier. Sorry, go on.
Go on.
I think the key risk here, so it's quite clear. We've got a building. We've then got decisions to whether we want to keep it. So JPH, our Jersey Property Holdings, our corporate landlord, is developing asset-specific property asset management plans. So that building will have a life. They've consulted with the relevant department to understand the requirements for that building in the future. Is it needed? Is it not needed? They'll put forward a case as to whether it's required or not. If it is required, they'll put forward a assessment of the works that need to be undertaken in order to sustain it at the right standard. That will all be embedded in a business case. That is approved through the process I described earlier. It comes to the Treasury. There's an officer consensus as to whether that's recommended and accepted or not. Often we will debate that internally, as you'd expect us to make sure that the costings, the assumptions are robust. And then it's onward to ministers to approve whether they are in agreement with what officers are recommending to them, and then ultimately the Assembly to approve. But much more advanced than we are today, where these decisions often are taken within departments or we haven't got those plans in place at all.
You talk about the role of Jersey Property Holdings in this. From what you're saying, it seems that there's going to be a kind of a breadth, an increase in the breadth of their role. So presumably they're going to have to be resourced in a different way, or certainly an increase in resources to meet the requirements that you've just said.
So we've already established a property strategy team. That was one of the growth initiatives in recent years. That team has been building the property asset management plans that I just described, so that they're ready. They're still doing that work, but they are going to be ready for the long-term capital plan to come. So it shouldn't necessarily require additional investment in people from a strategy perspective. Clearly, if there are works that we need to ramp up, that will involve a degree of extra resourcing, but that's more likely to be contractors who are doing work on buildings.
Because certainly what we hear from ministers is that, you know, there are insufficient resources within Jersey Property Holdings to do what needs to be done currently, let alone what needs to be done in the future to make sure that the JCIF is managed properly.
So I think where lots of that perspective comes from relates to maintenance budgets rather than the administration of what we're talking about here in terms of classifications and working with Treasury on the long-term capital plan. They've done a lot of work on the condition survey, for example, already. And this is another advantage of the fund is that maintenance budgets start competing with capital budgets as opposed to maintenance budgets competing with more nurses or more teachers or whatever it is, so that therefore all costs relating to capital are far more visible, and the trade-offs between those maintaining and building essential replacements, if you like, can be seen holistically rather than in a revenue budget over here and a capital budget over there.
Thank you.
Thank you. And will the proposed 4-yearly reviews of the long-term capital plan, are they going to be binding and statutory obligation like we have with budgets for new governments and things?
To the extent we could have it binding, we should put something in the PFM, Public Finances Manual, if that would be what the Minister would prefer. I don't see a need for it to be a statutory. We're not defining the long-term capital plan in the legislation as much, and we do that. Someone will change the name to it for it. We're saying this is the basis upon which that will be, or that ministers, departments, and those who scrutinise that will be able to look at a more evidential plan that's longer than the plans we currently put together, to be able to challenge whether why one project has been brought forward ahead of another.
Yeah, I think philosophically we've tried to be proportionate about the changes made to legislation and tried to ensure that core governance was rightly in the PFM. You know, if you look at the last change to the Public Finances Law, the definitions of major capital having a £5 million figure attached to them, actually, if you reflect on that, it's not something you'd want to do. You've not necessarily bound yourself. It would have been more elegant to put that in the PFM. So philosophically, that's been our approach.
Is that why, because one of my questions, to skip a couple, is can you provide the rationale for removing the definition of major project from the Public Finances Law and the implications of that? Is that exactly what you're talking about?
Yeah,
there?
so having a £5 million banner on it is not necessarily helpful. So we were going to retain the governance attached to major projects. So those that are going to be classified as major projects have a higher level of governance. They have to go through from the Corporate Portfolio Management Office to ensure they're really well governed. But also the only real fundamental distinction between other projects and major projects was that a total amount of money was approved for the project. Now, in practice, having lived with that for a few years, we've come to the point where we actually approve an amount of money, whether it's a £2 million project or an £8 million project. Once you're underway, it's very difficult to start taking that funding away. So we do, in practice, allocate a total amount of money to a project. We do give them inter-year flexibility. That was a key distinction in the law, and actually we're not working that way. So we were reflecting how we really work, which is when you've commissioned a building, you allow the project managers and the construction partners to finish it.
Okay. So in terms of finance law approvals, every project now will have the same sort of framework that only those above 5 million would have had. In terms of managing the projects, that's a separate set of definitions that sits somewhere else already.
Okay. And as well as the 4-year long-term capital programme, there's also mention of an annual refresh for exceptional cases. Who decides whether the new project should be added as part of that annual refresh, or I presume taken away as well as the other
So I think the key purpose of the annual refresh is to do what Deputy Rennick was describing earlier and just reflect where there's been a degree of slippage and a need to reprofile. We do that reprofiling, as we know, through the current programme. That's its primary purpose. There will be things that emerge, that you didn't foresee. Perhaps some event has triggered a degrading of an asset to an extent that wasn't otherwise foreseeable.
And who will make those decisions?
And it would be approved in the same way as all spending is, which is business case will be put forward, officer consensus through to the Council of Ministers, ultimately agreed by the Assembly. The difference with the 4-year refresh is that there's lots of big macro assumptions you have to make about population, about climate change and its implications for sea levels. They can't be reset annually, and you can't replan thoroughly on that basis. You can do that every 4 years, and that's about proportionate.
So the annual refresh will come to the Assembly as well?
Yeah, all approvals
yeah.
will be done by the Assembly.
Okay.
But the culture has to be, as we described earlier, there shouldn't be substantial annual change. This is failing if that happens. And we're
But
trying
it's
to build
constant.
that culture through this because, you've got new structures in place that make it add friction.
Yeah.
Can I just reflect on some of those comments you've made about the medium-term the long-term capital project plan, which in one reading could be the civil service basically saying, can we just make sure you politicians don't mess it up? Because we've got a bad record with the hospital, even in recent years, we've been slow on the school, we've changed youth clubs. There's been consistent shifts around with political changes. And in a way, what you're saying is, can we have less of that, please? You all sign up to a long-term plan, and can you please stick to it? Is that where this is driving?
I mean, that's not fair to characterise Phil as that respect. I would say it goes back to the question that you asked earlier: where is the accountability? And if you've got a long-term approach that's been agreed and it's gone to the Assembly, ministers who wish to change their mind and chop and change can now be held accountable for that because it will be clear that's what they're doing. That's how I would view it.
The opposite is also true. It's about ensuring the civil service is providing ministers the right quality and standard of information to make informed decisions, and I think that's been lacking. So,
I mean, a change of government is obviously a potential change of priorities.
Absolutely.
And so it's intrinsic there, but what you're basically trying to do is put a higher threshold in and say, look, you really did think about this before. Are you absolutely sure? Is that?
Well, that's a bit, yeah.
Be much more obvious, wouldn't it?
Politicians from all sides, and rightly, have asked us to give some more consideration to longer term planning. This is that first element of that longer term planning. It built up from evidence rather than guesswork. The next step will be long-term financial planning on the departmental side. So this is just so that you can think about sustainability of public finances, for example. The other thing is it will start to build up what that budget needs to look like over a period of time. Whether you swap and change a particular project, that expenditure will still be needed over the longer term.
For what it's worth, I'm broadly supportive.
Wrapping up this area really of 2 or 3 minor points, 3 odd amendments. First one, relating to stage trading operations. Regulation 3 amends Article 2 to give the Minister for Treasury and Resources, I quote, the power to approve an additional withdrawal from a fund if the amount required for a head of expenditure exceeds the approved amount, if there is a surplus available in the fund that is adequate. How does that change? First of all, how does that change from the previous position?
Broadly, as it is now,
I think it's probably the same.
That's what I'm wondering. So,
I think that's probably
It's
what
an
happens
amendment,
in practice, isn't it? Which,
but I think it will require that you have sufficient funds in a central capital reserve.
okay.
Rather like you have forgive the old parlance, general reserve, it will now be more segregated. There'll be a capital element of that and a departmental expenditure element.
It is a change, which is why we flagged it.
But they're always, At the moment, those two reserves are held as one, essentially. We operate them in the background as two, and I think we disclose some of this in the budget, but they're not separate heads of expenditure. So we sometimes use funds that we'd originally earmarked for capital reserve for revenue matters, and the other way around. This will mean that there will be a capital reserve within the capital fund and a general revenues departmental spend reserve in the general revenue fund.
Okay, I'm not sure I fully understand. In practical terms, there's not too much of a change to what you're saying. Is that
Not
right?
too much, no.
No,
It's just
okay.
different pots.
I mean, I think it's worth stressing that there's no immediate intent to change our approach with states trading funds, but there is the option to do that in the future, and it's about ensuring the law provides for that. It wouldn't make sense if we had lots of needs on the overall capital programme for us to have money sitting idle in a states trading fund. So we need to ensure that the law provides us the ability, should we wish to change TAC, to move that money to other priorities.
Okay, well, thanks for that. Only two more in this area. Can you please briefly explain the change to Article 24, which relates to the addition of a new paragraph to allow the Minister to make a transfer from the Strategic Reserve of up to 100 million to meet emergency expenditure if sufficient funds are not available in the General Revenue Fund? Again, maybe it follows the same pattern. What is the rationale for that, or is the reason for this change?
That one relates
I think that's already.
to emergency powers of the
Yeah,
Minister, recollect correctly,
Emergency
relating to use
expenditure.
of the strategic reserve if you're in a significant threat to health and safety of islanders, for example. Those are existing provisions within the public finances law.
So in practical terms, again, not really a change as such.
Largely not, I think.
It might be
Clarify.
consequential because of the division into General Revenue Fund and Jersey Capital Fund. It could just be largely consequential because of the renaming of the funds rather than the consolidated fund.
Okay, thank you. And I think my
The
father,
emergency fund would go into GRF rather than the capital investment fund, you would think, if there was a
Which article was it again?
immediate
24.
24.
24.
24.
I'll come back.
okay. I think my next final question really, that's already been answered, regarding all these consequential amendments, the amendments brought by the draft regulations. Can you simply confirm that these amendments affect are only to replace consolidated fund, which draft regulations deletes, with central reserve fund, which draft regulation inserts, or to replace government plan with budget? That's all that is being done, really.
I think they are I think they are largely just consequential in terms of terminology,
So again, in practical
Names
terms,
and-
so they don't.
catching up with budget
Okay,
government plan.
the necessary consequential changes to these words, really, and terms.
Yeah, I think they are.
We've just got to hope that the next government doesn't want to change it back to government plan. Undoing them all.
So just waiting for the Treasury. Has he got it on his
No, I
fingertips
think
or not?
if it's in the consequential amendments, it's consequential amendments arising from the split of the two funds,
Okay.
not bringing in a new.
Nothing new as such. Okay, thank you. I'll move on. Thank you.
And a change of topic now, independent taxation. We obviously heard at our previous hearing that individualitis effective rates for married couples and guidance were due to be sent out to islanders, I think in November. Can you update us on that process and any feedback you may have had from islanders? Have there been any challenges that have been faced by people? What's that feedback been like?
Well, I think, yes, we have sent out the notices. The notices were sent out from week commencing 17th of November, so everybody should have had an individual ITIS rate that reflects their own circumstances rather than the couple circumstances. So, Rich, do you want to talk about feedback?
Yes, I mean, as we anticipated, we did see an increase in footfall at the help desk and on our telephone lines. Not perhaps as much as we expected. We have seemed to be able to cope with it quite well. clearly, despite all of the communications we did do, some people were blindsided by it and were surprised by the change in their rates and so on. We've effectively, individually helped them understand the change. So I think it's gone as well as it could have done.
And what are the next steps for delivery of independent taxation?
We will probably send out or make another media announcement in the next few weeks about joint filing. So for people who wish to file jointly, they will have to make that election by the 30th of September. So we'll just remind people about that. The election form is not going to be available until April. Both the online and the paper form will be issued in April. So we'll do something at that point again, just to remind people that it's available. And then really the next tranche of action will be in the autumn going into the winter when, as I think we've said before, we'll start to ramp up communications, but particularly for married women who are perhaps making a return for the first time, and in particular for older islanders, I think we'll be ramping up the community help desk in the parishes. So that we go out to people rather than necessarily having to come into St Helier.
Okay, thank you. And then personal income tax, obviously the window for submitting tax returns is open. Can you update us on any issues there may have been, resourcing systems, that kind of thing?
Yes, we've had about 12,000 returns, just over 12,000. Returns filed already, and about 8,000 of those have been filed online, which is a slightly better position than last year. There's been one glitch in the system, which is a global issue by the provider of the underlying software, and we think it's affected about 24 islanders potentially. So it's not a big issue, but a few taxpayers have reported that if they file online and save the return midway, so they haven't entirely completed it, some of them have experienced effectively a loss of the input they've made. It's a random glitch. It hasn't affected everyone who has stopped a return midway, and the software providers and our digital services people believe they have now found a solution which is being trialled and tested this week, and I think they're hopeful we'll be able to roll that out and make an announcement later this week. But as I say, it's a relatively small glitch, random in its effect, and it hasn't affected too many people. And
you don't expect that it will have an impact on the numbers that might file online or anything like that going forward? I don't think so. In terms of online filing at the end of 2025, we saw another 2 percentage point increase in uptake of online filing, so it went from 52% to 54%. We're still a little disappointed by that. We really would like to see a step change, and we are doing a project which is effectively targeting new entrants to the labour market, particularly school leavers and so on, and encouraging them to file online. Do you have a target for this year? Well, we don't set a target because we don't really have levers to influence it. I mean, we always aim to get as many people filing online as possible. I think the next big potential step change will be if we start to get more school leavers immediately filing online.
So that's where we are focusing the effort.
For example, we've kind of focused on the fact that school leavers, the first communication they get from us has included, here's a paper tax return. So if they start by sending people paper tax returns, we're trying to get away from that by encouraging them onto online filing straight away. And you would imagine young people will not have a problem with doing that. And we're also backing that up. We have I'm about to briefing next week, I think, on the
Yes.
we're calling it Revenue Ready education programme for schools, which we're going to start rolling out quite soon. So I'm waiting for the briefing on that. So that's quite an interesting development.
Do you think that the online, the necessities around kind of the ID verification stuff, does that impact on people filing online?
I think when we first introduced online filing and we just had the YOTI application, quite a lot of islanders did find that daunting, partly because it required them to have a passport, and quite a lot didn't, apparently. We then introduced the Jersey Me service, where it's possible to validate identity in the post office, and it's somewhat different to YOTI. So I think that's helped. But I think there is a degree of resistance to ID verification.
Extra barrier, isn't it? When
there
you've got a
is.
form there you can fill in, or
Yes.
you've got and that takes some time, and I've got to go and do this and
Yes.
do this.
But it is absolutely essential to protect people's identity from identity fraud. So it has to be done. So hopefully, I personally find YOTI works very well for me, and I think most people find it. Some don't. I think again it's a little random.
If you shaved your beard off, you wouldn't have exactly the same experience. It wouldn't recognise you properly.
Yes. Yeah.
And the equivalent for the paper form is because it's got your unique number on it and it's been sent to your home address. Is that?
It's got your unique number. It's been sent to your home address, and we do have your wet signature on it.
Okay.
What about a 50 quid discount for somebody paying online?
I think that's a question for the Treasurer.
I think it's probably like the same thing as giving people a discount for prior year debt. You benefit those who are
Indeed.
technically savvy or more able to deal with it at the prejudice to prejudice those who can't, who simply can't or don't feel up to it.
Okay, thank you.
Corporate income tax, Pillar 2, or the get out of jail card, as I like to call it. The registrations by in-scope organisations for Pillar 2 were due at the end of 2025. I think you then gave an extension at the end of February.
Yes, that's correct.
So why was that extension?
So, the reason that we gave the extension was because we'd heard from a number of tax agents. They're being approached by service providers to onboard their clients, and that there was the due diligence, know your client procedures that have to go through. And they were saying they wouldn't be able to meet the 31 December deadline as it stood, and we're saying that actually they would have to turn away business. So we had consulted with industry, a wide range of the agents, and they were all saying the same thing. So we decided at the end of December to extend to 28th of February as a blanket extension. So it means that any year end up to effectively the 27th of February has now got until the end of February to file on time. And it's also now been mirrored by other jurisdictions as well. We're not the only jurisdiction that's extended.
Do we now know how many, I mean, we must have a very clear idea by now of how many organisations are signing up.
Well, we're going to carry on. This is technical, so we can keep going.
So we know that there's a deadline for 20th of February. There's also a registration deadline for the March year ends as well that would have up until 31 March to register. So you're correct, as at 1st of April, if everyone has registered on time, then we'll know what the numbers look like. Just now, we have just over 200 groups on Ireland that have registered, and that accounts for just shy of about 1,200 standalone entities.
So we're getting there.
Is that
we're not
roughly
quite
what
there.
you'd expect? Or you've done a lot of engagement around
That's
this.
it's just a little bit shy, but bearing in mind the lead time, we're not far off what we expected to be, but it's just a bit shy of it.
So
But
how
we'll
is it
expect over the next weeks, as Jonathan said, that we'll get roughly to the number that we expected.
So how is that translating into revenue forecasts?
Well, don't forget, we don't get the first payment on account is due at the end of May. So the registration we will have to wait for that first payment on account.
But you must have some ideas looking at those figures.
Well, we've been very, very careful all along to just talk about the base case, which is where we can be certain. That base case, we believe, continues to hold true, and we don't think it's either sensible or responsible to try and second guess what the actual amounts might be. And even after we've had the first payment on account, it might still be challenging, but we'll have at that point we'll have a much better handle on what the number will be coming in this year, for last year's liability, of course. So that will make last year clear, but what it won't do is give us any indication necessarily of what the going forward figure will be.
You've got 52 or 50,
Around
50 million,
each.
let's
It
say.
starts at
50
48 and ends up
48,
at
yeah.
52 for the
But
4-year period.
Are you quietly confident that you will get more than that in the sort of, I don't know, 50 million range more, or what?
Well, as I have said all along, that number is the base case. What we've done is look at those companies who we know are already paying, will fall within the new 15% rate, and have got such substance here in Jersey that they're what you would consider to be sticky. As we've gone through this process, and as Jonathan says, we've got these 1,200 now registrations, we are more confident that there will be an upside, but we still think it's prudent to wait until we've actually had the payments on account to talk about what amount that might be.
And if there is that upside, how confident are you that it would be sustainable? I'm thinking here in the context of a budget that depends heavily on funds that are not sustainable in terms of the Social Security Reserve Fund and so on. So do you put this in the same category?
We'll leave the Minister to reply to your little political jibe about
I don't think it's political,
Social Security
I don't think
Reserve.
that's fair to say it's not sustainable.
We'll come back to that, because I think let's keep
Beyond 4 years.
Just ask me the actual question again.
How confident are you that the upside will
So,
will last?
That again will depend on what the payments on account are and from which firms at the end of May. And the reason I say that is because we'll be able to look at those companies and have a good understanding of whether they might do some restructuring or not, what restructuring might be available to them. And therefore we won't know the answer to that question fully. So we'll have the numbers question answered, but we'll also have the whether it's just a one-off or it's likely to be to continue or not.
In terms of the instability around Pillar 2, the Pillar 2 regime, changes with the Americans and so on, can you update where we are with Pillar 2 in terms of going forward? What are the next steps? Things that you expect to happen?
So as you know, we developed a bespoke domestic cover tax, which should be which we believe is creditable under the Pillar 2 regime. What's happened is that the US have probably strong-armed through politics the rest of the G7 initially, at which point the game was over, the G7 to say that no, they were more concerned about the potential domestic changes in American taxation, and therefore they would concede that the US system was roughly similar to the OECD global tax system, even though one was global blending and one was jurisdictional. But anyway, that's all politics. So we're now in this position where there's a broad acceptance. We remind ourselves that we came to this with a number of priorities which are representative of our competitiveness position. That was, we wanted to comply with international standards, but we didn't do it as a tax raising measure. So any tax raising measure for us is an upside of compliance with international standards. We were also mindful at the time that there was a mismatch between what was Pillar 2 and what was the American system, and so we also tried to deal with what that mismatch was at the time. That mismatch, of course, has now fallen away because of domestic changes in American tax code around credibility of various taxes, and at the same time now the OECD have delivered side by side. But with that side-by-side statement on the 5th of January, I don't know how many pages it was, Jonathan, it was somewhere between 70 and 200 or something, of various clarifications and changes. So what we have done, mindful of those two initial policy principles that we approached with, what we have been doing is engaging directly with our big American institutions, but also being mindful that from our European institutions, they also want something. The things that those institutions want are not necessarily aligned, so we are now having to navigate through, are there any adjustments that we may make in the future? But that will be very much led by us wanting to remain competitive and be attractive to business.
Okay, we can leave it there if you want. Okay. I think that's very helpful. Thank you.
Do you want to go on to government grants as well?
Oh, they're my next as well.
You are.
Beg your pardon. Yes, and in fact quite timely, moving on to the temporary reduction in the state's grant to the Social Security Fund. The reason I said, by the way, unsustainable is as I understand it, you're only proposing it for 4 years, and therefore you couldn't keep on reducing. I wasn't passing comment on the 4 years.
I don't accept it's not a sustainable fund.
No, I wasn't saying the fund. I'm saying the transfers. Anyway, we'll leave it for that. You want to protect the long-term sustainability of the fund. What steps are being taken to ensure that that happens?
Well, there is a review going on. I mean, I think it came back to, I think we've seen a recommendation a year ago about reviewing all the purposes of the funds, and that's a reasonably big job. But there is a review going on about funding of the Social Security Fund. The Minister has instructed, I believe, the normal actual reports that happen every 3 years. It doesn't make sense to get them more frequently than that. It's an expensive, it's expensive, but certainly a time-consuming process. But the actuarial reviews will definitely help that, the actuarial response will help inform those reviews and how we look at funding in the long term. The Social Security Reserve Fund has grown now to 2.7 billion. And last year it generated investment returns of 250 million. So in comparison to the state's grant, that is a very significant sum of money in a year. Now that's a 10.5% return against a target of 6.8%.
Yeah.
Now, obviously, I don't need to be told that past performance is no guarantee of
And it
future
was an
success.
unusual year.
But, well, I'm not sure it is that unusual. It has generated very good returns, and at that cost at that scale, there is no reason why it should not continue to generate reasonable returns going forward. But that is all things that will come into the mix as part of our longer term financial planning. I think it's about it. The reserve fund, I think, I don't believe it ever had a target for size. I mean, it was there to deal with the bulge and the ageing population. But I think there was a broad indication that it wanted to be 5 times spend. It's now at 7 times annual spend. So I
Can
think
I just
there's
pin you
numbers.
down a little bit? You said there's a review going on. The Social Security Minister told the Health and Social Security panel that there was a commissioning a separate piece of work in the context of the Social Security Fund, the amount of tax-funded money that goes into it each year, the level of reserves it would be prudent to hold, the way in which other countries address these issues. This broad review, which is not a straightforward actuarial review, it's in other words, its addition, is a much broader policy-based review, and that will be ready for the incoming ministers. So is that work you are involved in? What is that piece of work?
That sounds like a bigger policy thing rather than what I suppose our review is looking at where we are at the moment. If we continue what we're doing, that sounds like a different piece of policy work in terms of looking at how our fund compares with what other people do. And I'm always slightly reluctant to start comparing ourselves with what other people, unless we're comparing apples with apples. But I don't know can you
Yeah, it's been
explain
led by
what our
Social
review is
Security.
doing?
I mean, I think it just brings into play the objectives of the fund. So objective neutral, as the Minister says, we're in an excellent place. Whilst last year was a good year for returns, we've averaged over 9% over a really long period of time. So we have achieved investment returns far in excess of expectations when the actuaries informed the original formula. That work will look at the sustainability of the fund as is, and also look at other policy objectives that you want to reflect on.
So
as well.
you are currently doing a piece of work in Treasury to look at the
It's the
Social Security Reserve
the
Fund.
Minister that's leading that work. But we're involved, yeah.
You're involved, okay. And what is the timetable for delivery of that work?
So I think it is intended to have, I don't have the hard deadline, but it's intended to be ready for the next government.
And there's a terms of reference for this, and it's is this just a kind of, look, we're having a look at this, or is this a serious piece of work with terms of reference and a delivery schedule and objectives, all of that kind of stuff?
It's a little outside my responsibility, Treasurer. So
I'll have to confirm in terms of actually written terms of reference, but we are involved with that. We'll confirm that for you.
Okay, because I'm a little confused about the number of different things. Full actuarial review,
But the
got it,
actu-
understood.
Actually, you have to have anyway.
Is this piece of work that the Social Security Minister told us about the same as the piece of work that you've involved in?
No, that's the piece of work. You wouldn't expect us to run separate pieces of work.
But you don't sound that involved if you don't know.
Well, I'm not personally involved. I am, from conversations, thinking that one of my officers is involved.
yeah, strategic finance colleagues are involved. It's a formal review. I'm sure there's terms of reference, but we'll get back to you on the structure of it.
Thank you. I've just got a quick question about insurance. So can you just talk us through the process followed when insurance claims are paid back to government? So, for example, a good sum of money was taken out of the strategic reserve to fund the emergencies that we had back in 2022, 2023. How is the process of those costs getting repaid? How does that go ahead?
So more generally, when department suffers an insurable incident, they have their budget to meet the consequential costs of that pending an insurance claim. If they therefore spend that money from their existing budgets, then when that insurance award comes in, it will go to that department.
So when we have a major emergency and a considerable amount of money comes out of the strategic reserve to fund, where does that repayment, how does the insurance claim process work?
So in principle, I'd expect that to go back to the strategic reserve, but if you give me the example, I will go back to confirm that position.
For example, Hodemore. You know, a significant amount of state's money.
So, of course, there's a lot of expenditure incurred that wasn't insurable.
Okay.
The majority of the insurable costs relate to the owners of the property,
Yep.
which in this case is Andium. So there is an awful lot of expenditure in respect of Hodemore that wasn't covered in terms of insurance, and there's obviously deductibles in terms of how much you have to, or what we normally think of as excess on our personal policies, they would expect us to bear as well. So in this case, the majority of those insurable costs related to those to the damage of property.
Okay. Okay, thank you.
Moving on, Minister, could you provide an update on the use of the revolving credit facility, please, and the process followed to access the facility and its current position?
So we use the current RCF twofold. One, we use to fund the, as part of the borrowing approved by the Assembly, to fund the new hospital facilities project. And secondly, there's a change in legislation allowing us to use that facility as overdraft, which previously it didn't until those changes were made, I think, in the budget before last in terms of approvals. So we use it for those two purposes. The drawdown, I think this at the end of the year, was roughly 100, where's my numbers gone? Roughly 100 million in respect of each of those, leaving 100 million headroom against the current level of the RCF. The RCF does have what we call an accordion facility up to 500 million. Obviously, the 500 million is still within the borrowing approvals for the hospital and the powers of the Minister in respect of overdraft as well. So we are currently undertaking a piece of work to say when and working with the NHF team to understand the cash flow requirements, in particular this side of the period of election sensitivity, notwithstanding the other item we just touched on, which is at the end of May we have a highly variable amount of money that we may get in arising from Pillar 2 for the part payments. I think personally I need to take a prudent view of that. We can't get halfway through the period of election sensitivity and not have the funds in place to make sure that the hospital can proceed and to fund ongoing cash requirements of the states. So we're doing that piece of work in terms of a cash flow to advise the Minister as to whether we execute one of those increases to the size of the revolving credit facility amount.
Thank you. And can you just briefly explain the link with Andium and the revolving credit facility?
So Andium have their own revolving credit facility.
Right. So, and when I then come on to my next question, that's the Andium one. So can you just briefly explain the Andium one to me and how that one works as well, please?
So revolving credit facilities in terms of capital projects, so the same for us is obviously at the start of a capital project, and if I talk about the hospital, but it applies to Andium as well. At the start of a project, if you go out and spend, or you go out to market and borrow £250 million, and £250 million lands in your bank account, you have to be paying interest on that bond, and you've not necessarily spent the money. And RCF, in this particular case, means that your level of actual debt increases as you spend money and develop the sites, rather than having all the money up front. So it gives you it feels a bit like an overdraft facility. It's not an overdraft, but it builds as you spend money. So that's what they're using there in terms of matching against development costs. And that what you'd expect further down the line, as in the case with the states, is you convert that into a more permanent arrangement, either in our case by the issuance of bond or going to banks for a fixed amount of borrowing.
And when it comes to the Treasury Minister's involvement with Andium's borrowing or that use of that revolving credit facility, how does that work? And I'm referring to, I think there's a recent States written question which was also covered in the media, which then talked about the level of borrowing, Andium Homes borrowing expected to surpass 500 million. And Minister, you stated that it's the responsibility of the Andean board to monitor financial viability and debt levels in accordance with their risk appetite. I remain satisfied that the necessary assessments have been regularly undertaken. What engagement do you have with Andean to make sure, to give you that confidence?
Yes, well, before they take out, before any of the state-owned entities go into a borrowing arrangement like that, they themselves take quite extensive debt advice, and they then come to us, we then look at it, we review it. I'm not sure if we take external advice on it where need be. So we go over it all again to make sure it's satisfactory, that they can use it. And again, Andium, they will use the revolving credit facility in the same way as we do to get the most cost-effective means of funding in a particular situation. There will come a times where fixed term finance, they might swap it into fixed term. But it is, they don't just say, oh, by the way, we've entered into a new £100 million facility. It's a done deal. We know about it in advance, and we have to check over the whole viability and how.
Do they notify you, or do you have to approve it?
I think we have to prove it. You have to prove it.
How would you know that there was a problem with it? I mean, there must come a point at which there's a theoretical possibility you'd say no. So how would you? Who would tell you that? Who would tell you
our
that
own
that was?
advisors, our own review, and our own advisors would say, this is. I mean, they're not using a kind of one man and his dog in a garage type of debt advisor. They use very sensible debt advisors, as do we. And if our advisor said we have concerns about this, then we would go away and ask questions and make sure those questions are addressed before we gave approval for them to enter into the funding arrangement.
The point of having a ministerial input in it is to have a second opinion about it,
Yes.
and it wouldn't be valuable if it was just a tick because it was.
It's not just a tick.
Yeah.
It's not the state-owned entities. It's not. I am not a rubber stamping process. Absolutely not. And I think if you ask them, they would probably tell you that as well. I'd like to think they would tell you that as well. That we do look very closely at these type of proposals. It's the same with when they go into new development. They come up with their plan. We have a third-party quality assurance of any development they do. So we're using third-party advisors. So we do have appropriately qualified people looking at all these proposals before we say yes. And if we had questions, we would ask questions, and we do ask questions.
And in response to that written state's question, it said that the revolving credit facility first agreed in 2020 and extended in December 2025. So is that a decision that came to you and you approved the extension of that?
Yes, it would have done. I can't remember the date. Sorry, I've been with.
So recently, in the past few months, the extension would have been agreed by you.
Yes, initially, Andy in the first instance talked to the officers, so Steve, he's our main point of contact. They raise it with him, and the officers review everything, and then it will come to me for a decision. And we will talk about them. I'll ask questions. I read the papers.
Okay. Does the housing minister have any input into those kind of
I
decisions?
think possibly less so with the financing, but I think in terms of development. So if Andy came in tomorrow and said we're going to build 30 new houses on this field, then the housing policy team are engaged at that level. Okay. I don't think they're involved as much with financing, but we would look closely at the financing to the extent that was engaged.
Thank you. And just so for the public record then, because I don't think the written question actually stated how much the extension was. It said what the total from the revolving credit facility was. How much was the extension in December for?
I don't remember. I don't keep
That's
numbers
something
in my,
perhaps we
I
could
don't
ask
keep
for
numbers in
in
my head as a rule
follow-up.
because there's too many of them.
I think it was an extension of the facility.
It's yeah.
So they haven't necessarily drawn it down, it's the extension
You're
of...
extending the facility
Fine.
per se, so whatever it was.
Okay,
I can't
thank
remember
you.
if it was making it bigger or if it was just making it more available.
We'll come back.
We'll come
Thank
back.
you.
Okay, thank you. David.
No, right. Sorry. A couple of questions on the state-owned entities, which I know you're dying to hear. can you please update us on the nature and extent of any recent engagement meetings with SOEs to which you have a role of shareholder representative, and do they focus on any particular challenges you see before during your term?
We do, yes. I meet with all of them quarterly. So in the last, there's so many, I try to meet with them quarterly. I have recently met with Ports and GDC in the last few weeks. I think there's a post one coming up very soon. I can't remember my diary, but I do meet, I meet them, I try to meet them quarterly. We will have the full shareholder pack, which will include their finance update. It may be certainly their finance update, chief executive report, things that they are working on. We operate a general no surprises policy where they should tell me in advance of anything that we need to know. So with Ports, for example, we've discussed some of their big projects quite recently. I think they have some announcements coming out very soon about the airport. So I think we have a good relationship with them. If we needed an ad hoc meeting, we would have them. They may phone me for, I'll get the occasional phone call saying, just so you know this.
Is there any common theme come from those?
Not necessarily. I think with Ports recently we've looked at strategic business plans recently. After those meetings, where we can discuss anything we're concerned about.
Leading on from that, you'll have recently seen, if not fully yet read, the report from the Public Accounts Committee on these bodies. Have you had a chance to consider it in any depth?
I did read the recommendations very quickly, and I think the SOEs, I mean, my sense of it from a reasonably quick reading was that the SOEs are generally accepted to be, the governance arrangements are good. We do see them regularly. They follow corporate code. We've got the MOUs. We do look to, there is a rotation of non-executives and chairs in line with corporate standards. So I think that relationship works quite well. I think I have a very open relationship with them.
Yeah, I'm aware of the time, Chair, but the...
I think putting, I'm slightly, I think it's unfortunate the state-owned entities seem to be, are quite often put in the same bucket as the LOs because they are quite different things.
Okay, I take the distinction, yes. I mean, I did have here some specific questions on recommendations, but time doesn't really permit, and you'll be replying to these recommendations, obviously, in natural course.
We will reply in due course when we've had time to.
Okay,
when they've had a long time to pull it together. I think we need some time to respond.
We'll await those with glee.
Thank you. Thank you. We're coming to the end. We've just got a few minutes, so really the last questions are just sort of on your reflections as your time as Treasury Minister. So really, looking back over your term in office, what do you consider to as being the most challenging aspect, and what areas of opportunity for progress have become apparent?
I think in general, the whole recognition that we are, as government spending rather more than it should. I think everybody's accepting of that, but we seem to struggle to rein that in quite a lot of ways. But we've made quite good progress trying to do that. I think it is something we have to continue doing going forward. And I think the team have done really good work on long-term capital plan is something they worked on for a long time. And then they got swept into investing in Jersey and Jersey Capital Investment Fund, and that underpins that very well. We do have more to do in terms of, as we've said, multi-year budgeting we think will help that. I think the Treasury Minister historically had greater powers than I have, and I think we need to reinstate some of those powers as a means of, again, trying to bring that back in line. We have made good progress with independent taxation, although it's very frustrating the number of times we have a decision that seems to be tweaked, fiddled with. It is I think the tendency that we have to try to reopen previous decisions is unfortunate, particularly in the financial tax sphere. It doesn't help us plan. It doesn't make for It doesn't make for an easy or simple system to operate. It doesn't make for a cheap system to operate when you've got multiple options running round. And I'm sure there are lots of things, I'm sure the Comptroller will say there are lots of things we could do to make our tax system easier and simpler for individuals. But just the scale of work and trying to fight through that, I think would be a huge amount of work. I think we have done some good work. What I probably didn't expect at the start of 24 was to spend quite so long on matters relating to connectivity. We spent a long time in 2023 discussing sea connectivity and contingency for that service, how we just stability of that service and contingency around it, and making sure that we were not in a position where we would find ourselves without a boat. So that took up a huge amount of time. And then last year we had similar issues around air connectivity, and I do think that, has painful as it will have been for a number of people at the time, I think we are in we are in a stronger position now with Loganair than we have been for some time. And that's no criticism of Blue Island. They're a small airline and they have the issues that arose with being a small airline. I think as it settles and we deal with all the services, I think DFDS, I think we will be in a strong place with DFDS going forward. But that's not really my bag. But I do think that does put us in that puts us in both of those changes, put us in a strong place. So the team have all done an inordinate amount of work on all of those areas, for which I'm very grateful. Then the other thing that took up a lot of time last year was the Manx deal with Jersey Telecom. So it's been very busy. And although there are some people say lawyers shouldn't be anywhere near the money, I think my particular skills have been quite helpful in this. Some of the things we've had. And
You
it's
didn't,
just
you didn't mention dealing with scrutiny as one of your
Surrounded
highlights.
by accountants. Surrounded by accountants.
Surrounded by accountants, yes. Nothing wrong with accountants.
Leaving that for us to say.
I am just conscious of time, so I just want to thank you all for your time today. Thank you to you, Minister, and